Production, Costs, and Profit, Lecture 11. Let's start by defining the production function. A production function shows the relationship between a quantity of inputs used to produce a good and the quantity of output of that good. So we start with the factors of production: land, labor, and capital. Of course, they go into the firm or factory, and out comes our output. The firm is the organization that combines inputs of labor, capital, land, and raw materials, or finished component materials to produce final output. The production function. The quantity of output Q, technology, natural resources, labor, capital, and entrepreneurial ability. So the idea is if you plug an amount of labor, capital, and other inputs the firm is using, the production function tells us how much output will be produced by those inputs. For simplicity, we use a shorthand version where we basically say that output is a function of labor and capital. We're not going to be using natural resources or entrepreneurial ability for our work. So different products have different production functions. The amount of labor a farmer uses to produce a bushel of corn is likely different than that required to produce an automobile. Firms in the same industry may have somewhat different production functions, since each firm may produce a little differently. For example, one pizza restaurant may make its own dough and sauce, while another will buy those items pre-made and put them together. Short run versus long run. The short run is the period of time during which at least some of our factors of production are fixed, which means we have a specific amount only for those factors. During the period, let's say in a pizza restaurant's lease, the restaurant is operating in the short run because it's limited to using current building. The owner can't choose a larger or smaller building while it's under a lease. In the long run, however, this is a period of time during which all factors are variable. Once the lease expires, the pizza restaurant can basically move to a larger and smaller space based on their needs. Total product and marginal product while using labor as our input. The total product is simply the output that is produced by using all the employed workers in the organization. The marginal product that is generated by an additional worker. There is a specific law called the diminishing marginal product, and in the case of labor, we'll be thinking about the diminishing marginal product of labor that states the following. An increase in one input while holding other inputs steady will lead to a rise in output, but this rise will not be consistent. The increase in output may be substantial in the initial stages, but additional units of the input will lead to slower growth or in the output. After a certain point, the output may stop increasing or may even go down. This is because of the law of diminishing marginal productivity. Let's think about a space. Let's say in 500 square foot space, we have one desk for somebody to produce written notes from this lecture. And we have one desk and we have one computer on it. So there's our capital component. Now, when we bring in our first worker, right, that first worker becomes very productive and starts to produce more and more units of note-taking. What if we bring in a second worker while keeping our desk and computer inputs constant? Well, what can they do? Well, the second worker comes in and they can take breaks and switch off and maybe still increase the total product of the good. But what if we get 5 or 6 or 7 workers, again keeping our one desk and our one computer fixed? All of a sudden, there starts to be more noise, right? More rattling activity as people are standing by without work to do. That's what we mean by the diminishing marginal product. Fixed versus variable inputs. Pizza shop example. Fixed inputs are those that cannot be easily increased or decreased in a short period of time. Let's look at the example of the pizza shop. In the pizza shop, the building is a fixed input. Once the entrepreneur signs the lease, he or she is stuck in that building until the lease expires. Fixed inputs define the firm's maximum output capacity. Fixed input do not change as output changes. So even, as you produce more and more pizza, you're not going to get more building, right? That's not a change you can make in the short run. So fixed inputs do not vary with output. Variable inputs are those that can be easily increased or decreased. So again, back to our pizza shop, you can order more ingredients with a phone call, so ingredients would be variable inputs. The owner can hire a new person to work the counter pretty quickly. Variable inputs increase or decrease as output changes. Example, let's say you run a small coffee shop with 2 espresso makers. The size of your coffee shop and available equipment are fixed, so you can't buy another espresso machine in the short run. Let's calculate the daily marginal product of each barista. So we'll say the marginal product of barista is found by the change in output, which is how much does production increase as a result of hiring this extra worker, change in barista. So let's start with our first one. When we hire one, we're at 0 baristas. When we hire one barista, our output is 180 cappuccinos. The marginal product of that barista is 180 cappuccinos. What about our second barista? Once we hired the second barista, our output goes from 180 to 320. Now that is a change of 140 units. Notice that the marginal product of that additional unit of labor actually decreased. What about a third barista, fourth and fifth? Notice they're all competing to use these 2 machines, and therefore you have a situation where as you get more and more baristas into the store, you're starting to see the diminishing marginal product. It could be that people are standing around or don't have anything to do, but there's lots and lots of reasons for this. If we could increase the number of espresso makers every time we hired a new barista, we may continue the total marginal product changes to be fairly consistently large. This is a graph of the previous table. So here we see the total output or total product, and on the x-axis we have the number of baristas that are currently working. So if we have 0 baristas, we produce 0 output. It doesn't matter how many coffee machines that we have. When we have 1 barista, we have 180 units of cappuccinos made. And notice as the workers increase, the total product curve initially starts off with a steep slope, but gets flatter and flatter and flatter. Eventually, there will come a point where an additional barista will actually decrease the total product or total output for that firm, right? This is obviously a situation where too many workers with not enough tools. Now, what if we go to the marginal product of the baristas? Again, notice the first barista adds 180 units of cappuccinos, the second 140, the third 100, and so on. Eventually, as you get probably past 6 or 7, right, the marginal product of the additional barista is actually becoming 0. This is not that different than thinking about the diminishing returns to capital as well. So diminishing marginal returns, the marginal product of a variable input decreases as the variable input increases while others remain fixed. Let's look at an example of capital. So in the case of capital, let's say you have a job and it is to take notes for, I don't know, this class. And currently you have a piece of notebook paper and a pencil. What if we added another unit of capital for you? For example, a second pencil. Is that really going to add much to your output? Probably not. What about a third or fourth? Right? Once you have 1 pencil, that really is all you need. So additional units actually have diminishing returns to capital. The costs of production and profits. Let's start with a few definitions. So in economics, we have to define the difference between explicit costs and implicit costs from accounting when we're talking about profits and revenues and costs. Explicit costs are out-of-pocket costs, that is, payments that are actually made. Things like wages that firms pay to its employees, rent that a firm pays to its office are explicit costs. Implicit costs. These are what we consider in economics. in addition to the explicit costs. They represent the opportunity cost of using resources already owned by the firm. Often for small businesses, they are resources contributed by the owner. For example, the salary you gave up to start your business, working in the business while not getting a formal salary, using the ground floor of your home as a retail store. Those are some examples of implicit costs. Explicit versus implicit costs. Let's look at an example. Marcy started a consulting firm. She's using an office building she owns that she used to rent out for $60,000 a year as her office space. She purchased computers and other equipment for $25,000 and spent $20,000 on marketing and advertising. She also hired an assistant for $30,000 a year, and her other expenses such as utilities are $15,000. If Marcy worked for another firm, she would earn $100,000. Her revenue for the year was $150,000. Now, what are Marcy's implicit costs? Well, her implicit costs are basically the fact that she's not going to be earning the $60,000 in rent that she was getting before for her building, and also she won't be earning this $100,000 she could have earned working for another firm. Therefore, her implicit costs are $160. This has nothing to do with accounting, right? In accounting, all we're concerned with is the actual implicit cost, which explicit costs, which are $25,000, $20,000, $30,000, $15,000, and we would take the revenue, $150,000, subtract from our costs, and we would get accounting profit. Sunk costs. A sunk cost is a cost that an entity has incurred and which is no longer able to recover. Sunk costs should not be considered when making the decision to continue investing in an ongoing project, since these costs cannot be recovered. Instead, only relevant costs should be considered, things like opportunity costs. Sunk cost examples, for example, a marketing study. A company spends $50,000 on a marketing study to see if new Auburn widget will succeed in the marketplace. The study concludes that the widget will not be profitable, and at this point the $50,000 is sunk cost. The company should not continue with further investments in this widget project despite the size of the earlier investment. And others, research and development, training costs, and also hiring bonuses. Revenue, accounting profit, and economic profit. So in economics, we divide between economic profit accounts for the implicit costs of production. So again, the lost earnings you could have earned doing a different job, rent you could have made, on a building you owned, etc. Accounting profit only considers total revenue minus the total explicit cost, outward payments. When corporations pay taxes, they only pay taxes on accounting profit, not on economic profit. Now, this is one of these always statements. Economic profit is always less than accounting profit. So later on, we'll see firms that actually have zero economic profit over the long run. But remember, that does not mean that they do not have accounting profit, right? Even if you have zero economic profit, that still means you have some accounting profit. Now, how do we get profit? Well, first we need to calculate revenue. Revenue is the price of the good times the number of units sold. The profit is the total revenue minus the total cost of production. Typically, we use the symbol of pi to represent profit, TR for total revenue, and TC for total cost. A few more definitions of revenues. We have average revenue. Average revenue is just another word for price. This is the average revenue earned from selling each unit, so same as the price. Total revenue divided by quantity. Remember, total revenue was just price times quantity. So if you solve for price, you actually get the average revenue, which is total revenue divided by Q. The marginal revenue. Now this is very important. This is the change in total revenue that results from selling one more unit. This is going to become a really key important criteria in our decision making of whether or not to produce more goods. An example of economic profit versus accounting profit. Fred currently works for a corporate law firm earning $125,000 a year. He's considering opening his own practice where he expects to earn $200 per year. He would need an office and a clerk. The office would rent for $50,000 and the clerk would be $35,000 a year. What is Fred's economic profit? So we need total revenue, which is what he expects to earn, to $200,000. Explicit costs, which is basically his rent and his clerk fee, so $85,000. And his implicit costs are the job that he's going to give up that earned him $125,000 a year. If these numbers are accurate, Fred's legal practice would not be profitable in the sense of economic profit. The average costs. Average total cost equals total cost divided by output. Average variable cost is obtained when variable cost is divided by quantity of output Q. Average fixed cost is the fixed cost divided by output. You can find average total cost by summing up average variable cost and average fixed cost. Let's watch a video of an example of a small bakery. Also, all of these equations will be available for download as an attachment to this module. So from the previous example, here's the graphs for the total cost, the marginal cost, and average total cost. Notice that the total cost is increasing as you increase the total number of units of output. And if we compare the marginal cost and average total cost, notice that the average total cost is the green one and is relatively flat, and it does intersect with the marginal cost. The marginal cost starts off a little flat and then gets steeper and steeper. Now, one very important condition is that the marginal cost curve cuts through the average total cost curve at its minimum point. Let's continue our bakery example. Assume we can sell each of our cakes for $12. Let's find the total revenue, marginal revenue, and profit for the firm. So if we sell 0 cakes, of course we get 0 revenue. The 20 cakes we sell times $12, we get $240. 35 cakes, we get $420, and so on. So this is our total revenue for our firm. When we go to the marginal revenue, we're calculating the change in total revenue divided by the change in cakes. So the first series of cakes between 0 and 20 give us a marginal revenue of $12. Second series also 12, 12, and 12. Notice the marginal revenue is effectively equal in this case to the price. That may not always be the case. Now, one thing that we have not yet fully discussed is to look at the, as we're going through this problem, look at marginal and marginal cost while I reveal the profit. So if our total revenue, if we produce 0 cakes, is 0, and the cost when we're producing 0 cakes is 20, and that's effectively our fixed cost, our profit if we produce 0 cakes is minus 20. If we produce 20 cakes, we get $240 in revenue minus the 80 in costs, and we get $160, etc. Let's look to see where our revenue is the highest. You can see the maximum is at about $340 of revenue, so it can be either 45 cakes or 50 cakes. It's somewhere effectively between that. But the point at which profit is maximized for all types of market structures is when the marginal revenue is equal to the marginal cost. Now in this case, notice here when we have 4 bakers baking 50 cakes, we have a marginal cost that is equal to the marginal revenue. It always makes sense to increase production as long as marginal cost is less than marginal revenue. Even when we get here where we're producing 45 cakes, notice that the profit is still about the same as the next case, but the marginal cost is less than the marginal revenue, so we continue production. So profit is maximized when MR equals MC. So remember, total revenue minus total cost. We can also find profit by taking the price minus the average total cost times the quantity sold. And that's going to be a helpful equation when we look at our profitability of firms. So we could keep producing as long as marginal revenue is greater than or equal to marginal cost. And profit will be positive as long as the price is greater than the average total cost. As we saw earlier in the previous example, the point where the marginal revenue equals the marginal cost is when we have 4 bakers and we bake 50 cakes. So if the bakery sells cakes for $12, how many workers should be hired? 4 workers. How much profit will we earn? $340. Let's look at some of those cost curves together. This is a typical average total cost curve where initially you see a reduction in the average total cost and then a swing upward. So this U shape is common in terms of ATC. The average variable cost basically is a similar shape except it's lower because the difference between the two is the average fixed cost. So the average fixed cost, notice, is always decreasing. It's highest initially when your output is very, very low, right? And then as you add more and more units of output, the fixed cost falls. And this is the marginal cost. Now the key things I want you to notice is that the marginal cost crosses the average total cost at its minimum, also crosses the average variable cost at its minimum as well. Why is ATC U-shaped? So as quantity rises, initially average fixed cost is falling, so it pulls down the average total cost curve. Eventually, the rising average variable cost pulls ATC up. Efficient scale, the quantity that minimizes average total cost. So this is the efficient point of production. As we'll see, this does tend to work out in perfectly competitive markets, but not in all market structures. So the average total cost and the marginal cost. The average total cost crosses the marginal cost where it is at its minimum. When MC is less than ATC, ATC is falling. When MC is greater than ATC, ATC is rising. Therefore, the marginal cost curve crosses the ATC at the average total cost minimum point. Costs in the short run versus long run. As we discussed before, some inputs are fixed, factories, land, etc., and those cannot be varied in the short run. However, in the long run, all inputs are variable. Firms can build more factories or sell existing ones. Depending on the size and what the firm does, there can be variations in what the short term and long term is. You can't really set a specific time period and say the short run is defined by 1 month, or the short run is defined by 7 months or 5 years, right? It really depends on the firm. So you can think of it this way. How quickly can the firm double production, right? In certain cases, you're already at full capacity in, say, your given factory, and the only way to increase your production would be to go to a larger factory, which can take time, especially if you need to build a factory or you're stuck in a lease. So, long run average total cost with 3 factory sizes. If we're looking at a factory size, small, medium, or large, and by factory size we mean the number of units of output these firms produce. Each size has its own average total cost curve. Okay, notice that the large firm, the reason it's large is because it produces more output, and the medium firm has medium amount of output, etc. The firm can change to a different factory size in the long run, but not in the short. So to produce less than QA, firms will choose to be a small firm in the long run. If they want to produce between QA and QB, they'll be a medium firm. And if they want to produce more than QB, they should be a large firm in the long run. So we get our long total cost. So the typical long run average total cost in the real world, factories come in many sizes, each with its own short run average total cost curve. So the typical curve looks something like this. This is basically what your long run average total cost looks like over the life cycle of a firm. So initially, the firm can experience economies of scale where as it produces more and more and more units, right, increasing its specialization and so on, it is able to reduce the average total costs of production. So as you make more, it's actually getting cheaper and cheaper to produce more units. There comes a point in the factory's life where now you have constant returns to scale, which means the ATC is basically staying the same as output increases. When you go to producing a very large number of output, you can start to experience diseconomies of scale, which is as ATC starts to rise as Q increases. Some firms actually never experience diseconomies of scale, and those are the types of firms we call natural monopolies that we'll discuss in lecture 13. How average total cost changes as the production changes. So economies of scale occur when increasing production allows greater specialization. Workers are more efficient when focusing on a narrow task. This is more common when output is low, right? Scale. Think about scale. Economies of scale means the more you produce, the cheaper something gets, except this is true usually in lower output situations. Diseconomies of scale, we're going the other way around. Once you produce so much output that you start to see these coordination problems in the large organization, management can become too stretched, you can't control cost, you get an extremely hierarchical type of system, and therefore start to see an actual reduction in your efficiency and an increasing in your average cost of production. So this is the end of lecture 11, and this is basically the toolkit that we need to analyze the profitability of firms in perfect competition, monopoly, oligopoly, and monopolistic competition.